go through the 5 F's, okay, when it comes to fix and flip. And that's funding, finding, fixing, flipping, and finishing. And so I'll go through those today, and I may stop at different points and do almost what sounds like an introduction, because I believe when I put it on my YouTube channel, if it records well and I'm going to use this, I'll probably segment this out into 5 different videos. So I'll have a funding video, and then I'll kind of chop it there. And okay, let's go with funding. We have an expression in my group. We say, dig your well before you're thirsty. Okay. So we want you to make sure that you are thinking about your funding and having money available to do a deal before you have the deal. And I know a lot of people say, well, I'll get the funding when I have the deal. Well, my business model has actually been raise the capital first, or have access to it, have a plan for it. It's going to make it easier to make offers because you'll have a proof of funds, you'll have funds available. But everybody knows about traditional lenders, so I'm not going to talk too much about that. The problem with the traditional lenders is you need good credit and usually good income. And sometimes when people get started in real estate, they don't have those 2 things. And income, not only does income usually have to be a certain amount of money per year, but also the type of income. They actually like W-2 income. They actually like employment income better than self-employed income. They see that, at least the market does, the lenders see that as less risky and more consistent. So traditional lenders, I have not, I'm trying to think right now, I have not done a fix and flip using traditional lenders. So all the flips that I've done, I've not used traditional lenders at all. So banks are not involved in my deals. Now, where I have used banks is when I use, people call it the BRRRR strategy, right? Where you buy, rehab, rent, refinance, and repeat. So I do it for my buy and holds, but I do that after the fact, or usually after I've already bought them for cash, or with my partner's money. So before you think of, wow, I can't do real estate because I don't have all this money that Randy's talking about having. Well, here's the deal. Of my current 6 flips that I'm doing right now, I think I only have money into 1 of them. So I've got 5 that are totally 100% leveraged through the models that I'm going to talk about, through my private money lenders and my equity partners. So hard money lenders, which is a way that quite a few newbies get started with their deals. And, hard money lenders, it's been my experience that it's always better than what it sounds. I mean, it always is, oh, we'll do 100%, we'll do 90%. Well, when you use private money lenders, remember this, most of them will have, they'll tell you a certain percent of the purchase, a certain percent of the rehab, but up to a certain percent of the ARV, the after rehab value. And who determines the after rehab value normally? They do. So they can tell you, oh, we'll do 100% of the purchase, we'll do 100% of the rehab cost up to 75% of the ARV. Now that might get you all excited thinking, wow, I won't have to come up with any money at all. This is great. I'm going to use this hard money lender. I got my money all set up. Only to find out that since they are determining the ARV, it might be a situation like this. Let's say you bought the property, you're going to get a property. We'll make the math really easy. I like math, but I always try to keep the numbers easy so I can do them in my head. So let's say you're going to buy the property for $100,000, and it's going to be $100,000 in rehab cost. And you're like, great, they're going to loan me $200,000. But when they calculate their ARV, you might have calculated the ARV to be $250,000. You're going to make $50,000 on this deal. So your calculation of the ARV is $250,000. So you're thinking, hey, 75% of that, I might have to do that math on my calculator. Okay, little under 200,000. So you're thinking, man, I'm going to be all set. I've got it 100% funded. But they come back and say, you know what? We're calculating the ARV at 220. And so 220,000 times 75% is 165,000. Guess what? That deal that you thought you'd have to come up with no other money, you have to come up with 35,000. So that's the kind of catch. I'm not saying not to use hard money lenders, but pay very close attention to what percent of the ARV they're going to do it, and then know that they're probably going to use their people to come up with the ARV. A hard money lender, they may not lend to somebody that has no track record, no experience, and it's their first one. And also, they always say, well, and people are, I think misinformed or naive. A lot of times they say, oh, it's all, it's asset based. It's just based on the deal. It's not based on my credit. I've not had any hard money lender ever do a deal for me or anybody else that they didn't run their credit. That doesn't mean that they weren't generous and they weren't understanding of credit issues, but they're still going to want to know, give me your income, give me your, run your credit. And a lot of it is going to be based on the asset, based on the actual deal. But believe me, they're going to look at those things, and experience is something else they're definitely going to look at. Okay, I'm going to go into private money lending. So I always ask this when I do some of my trainings. I say this, what's the difference? What can you tell me absolutely, positively you can say the difference is between a private money lender and a hard money lender? And I usually get all kinds of answers. Here's what I normally get. Hard money charges more interest. That's false. That's something you cannot say. That's an assumption. They'll say hard money, they'll charge you points, and a private money lender doesn't. That's false. You're making an assumption. They might say hard money runs your credit and private money doesn't. That's false. You're making an assumption. I advise you not to make any assumptions other than this one. By definition, a hard money lender is an institutional lender, which means a hard money lender is not lending their own money by definition. Then they would be a private money lender by definition. A hard money lender normally is lending somebody else's money. They're acting as a broker or a middleman or the institution of which that money flows from, really the lender to the borrower. So don't make those assumptions, because a private money lender can charge you points. A private money lender can charge you high interest. A private money lender can run your credit, ask to run your credit. So don't make those assumptions. Every deal is different. Every lender is different. I have private money lenders, and I use this case in point. I say, you know how much I paid for the very first private money lender I ever used? And they go, no, 24%. Like, what? You got to be kidding me. Yeah. Why did I do that? I didn't have a huge track record at that time. And I had some deals that I was going to make on an annualized basis, like 50%. And so paying 24% was a great way to get early in my career, to get a deal under my belt, make a little bit of money, and get some confidence and recommendations for more private money lenders. Guess what happened after that deal? Now the 24%, the whole deal took like 2 months or something, right? So I paid a few $1,000s. Guess what? After that deal's over, what do you think that private money lender said? Hey, Randy, you got another deal? You got another deal? Can I lend on another deal? And here's what I said. I was kind of like the street. You won't see the full effect with my jacket, but I'll stand up. Listen here, look, I don't have any 24%ers here anymore. I've got an 18%. I've got a 14%. I don't have any. They're like addicted, right? They're like a drug. I need the 24%. I need the 24%. Sorry, I don't have any of those. All right, but I've got an 18. I've got a 15. And then eventually weeded them down. And then the same lender that I used at 24, I think the last time we did a deal, I think was at like 13. Okay. So think about that as a possible, strategy to get your first one. So what do you need to secure a private money lender? A private money lender can be anybody, could be a friend, relative. What are the 2 documents you have to secure that private money lender? You need to have a promissory note. That's all the terms, condition, right? And then you have to have the mortgage. And what is the mortgage? That's the document that ties that promissory note to the property, which basically states if you don't live up to that promissory note, I can foreclose on that property. I can put a lien on that property and foreclose on that property if you don't adhere to the terms of that promissory note. So those are the two documents. I take on a lot of private money lenders all the time, and I secure them with those two documents. I have my own documents. And then the other thing is you have to record them. All right, that's what protects them, not just having the documents. They need to be recorded. Which one gets recorded, the promissory note or the mortgage? The mortgage gets recorded at the county recorder's office, okay? So here I'm going to throw something out. This is a little bit more, advanced. But let's say you have a friend and you got this deal and you already have a lender in first position, a private lender, let's say, in first position, and you need more money. And it's a friend that has never been a private lender before. They have a full-time job doing something else, but they're willing to give you the money, and they're willing to be in second position. You disclose that, and they're willing to say yes. Is that legal? Can you do that? Should you do that? Let me tell you this way. I'm not an attorney, but you are taking a huge risk that you are going to be in violation of security laws. And if something goes bad with that deal, you could be fined or jailed. And here's why. And in my explanation, and this would have to go to court, it would go to court, it would get contested. Believe me, you'd have an attorney fighting that you didn't break any laws. Here's the other side of the court case. Their attorney is going to maintain to the judge. I'll pick on David. David took advantage of my poor little client. My client has no experience in real estate. They've never done a deal before. They're not in business to be a lender. They're not a lender. They're just a grandmother. They're living off their, Social Security. They were taken advantage of. And because the first position lender foreclosed on David, because David did not adhere to the terms of the first mortgage, my poor client lost everything. It wasn't secured. That's not secured in second position, really, because she has nothing. What kind of security is that? All right. I would not want to be in David's shoes when that goes to court. So and I do have some people in second position, but here's what I do. I make sure that it's not the first time they've ever lent money, because that can be dangerous. Okay. For that reason, hey, if you adhere to it, everything goes well, there's no problems, they get paid, no problem. But you are at risk if it ever gets challenged in court that they're not in business. You say, well, people do second mortgages all the time. Yeah, but think about it. Those are lending companies. That's Wells Fargo in second position. That's, Chase Bank in second position. That's very common. And even private lenders, if it's a regular practice or a hard money lender, no problem. Hard money lender, institutional lender, that's their business. They're in business. They know lending. They know the laws. They know the risk. And even though you could explain it to somebody and even have them write it, like, my client didn't fully understand that they're actually risking the whole thing. So just food for thought, that be careful about putting any private money lender in second position because of that reason. Okay. Always, here's my disclaimer, always seek competent legal counsel. All right. With my training program, we've got all these disclaimers over and over again. I'm not an attorney, get legal counsel, not an attorney, but I did share with you what's been shared with me, other instructors, as well as other attorneys. Okay, so private money lending, you need those two items, all right? Equity partner, and I'm gonna also, when I go to equity partner, I'm gonna tell about maybe a rookie, somebody that doesn't have experience, how they maybe could get started in real estate. The equity partnership, I'm going to go, I've got a slide on it, and that's how I raised most of my capital, is through equity partnerships. Owner financing, I won't go real deep into that. I'm sure your training program has that. So owner financing, of course, is the owner, instead of, let's say I own a property free and clear, and instead of me expecting $100,000 for the property, you may make a deal with them, say, listen, the property in its present condition is only worth $100,000. However, if you do owner financing for me for 1 year, that would allow me to fix it up, you know, completely rehab it, resell it. When I close on the property, I'm going to pay you $110,000. So you're going to get $10,000 more. So even if it took an entire year, you just made 10% on your money. That's better than having me pay you $100,000 right now and then sitting in the bank for a year. You're going to make, you know, less than 1%. So that would be owner financing. Now, another version of owner financing is subject to, and I've done subject to deals. So subject to deals is basically owner financing, but it's when they have a mortgage. If they already have a mortgage in place, you can negotiate to take over their mortgage payments. And if you go to my YouTube channel, I've got a couple really good videos on subject to. One's a pretty short video. I think it's maybe just a 5-minute explanation about it. But then I go into a much longer, maybe a half-hour explanation on subject to. But I love subject to acquisitions. The best thing is you can do as many of those as you want because you're not on the mortgage. Worry about getting qualified for a bank. You're just making the mortgage payment. And I always use, when I'm explaining that to someone, I always use the term legally obligated to make your mortgage payment. That's much stronger than saying, hey, Tracy, if you sell me this property subject to, I'll make the mortgage payments for you. That doesn't sound very strong, right? Instead, I say, Tracy, if we enter in this agreement, I'm going to sign documentation, legal documents that require me legally to make your mortgage payments until I either pay the whole thing off, I sell it and pay it off, or I refinance it and pay it off. Which one of those explanations are stronger? Which one of those explanations might they consider doing? Just because of the terminology, and everything I said was true. All right. So again, subject to, you can get more information on my YouTube video. My subject tos to date have all been for my rental properties. But a subject to, you're going to pay that mortgage payment right away. Absolutely. But think about it. Instead of coming up with $100,000, now maybe your mortgage payment's only $1,000. So now you're coming up with $1,000 a month. So over a year, you're going to pay $12,000 rather than coming up with $100,000. But what you mentioned is definitely true. Here's the most difficult thing about subject to is doing the first one. By far, right? Because you have no credibility. If they ask for references, you have no one. So I've offered it to people in our investor community. I've said, listen, if you want to partner with me on if you have a subject to deal, but you're concerned that you're not going to be able to pull it off because you've never done one before, let me know and I'll partner with you. So the first one I did, and this is kind of my strategy, kind of goes back to why would I pay 24% for a private money lender? Well, because it was my first one and I didn't want to be handcuffed for the rest of my life, always looking for the first one. Well, the very first subject to deal that I did had little or no equity. In fact, it probably had negative equity. I was probably assuming about $10,000 in negative equity. You say, why would you ever do that? Why in the world would you do that? Well, I did it, number one, because it's a rental property and I don't buy for equity in my rental property, I buy for cash flow. So it cash flowed, and it was completely already redone. All I had to do was put a renter in there. The cash flow at the time when I bought it, I think was about $100 or $250, something like that. And the amount of money I put into it on that first property was like $1,200. Well, think about it from a return on investment standpoint. If I put in $1,200 and I make $1,200 every year, I just made 100% return on my investment. All right. So one of the most recent subject to deals, I evaluated the deal and it was going to be a much better deal. The cash flow was even higher. The cash flow on that is about, well, the cash flow, I guess, on that is there's equity in the property. So we already got equity of maybe $20,000 in equity. But in addition to that, the cash flow is like $250 a month. So you multiply that by 12, we're over, 2,500, more than $2,500 a year in positive cash flow. I had somebody bring in, think about it, somebody for the rehab, we did have to do a little bit of fix up work. So I had somebody bring in, I think, $10,000 or $15,000, but his return was still going to be like 15%. So he put in all the money. I did the deal. He put in all the money for the rehab. So I got a deal that really my return is infinite. I have no money into it, and I'm getting $120 a month, plus have about $20,000 in equity. Plus, that's the cash on cash. We're paying that mortgage down. The mortgage that we're paying on, I think, is about 3%, 3.5%. And our mortgage pay down, our principal pay down every month is over $200. It's like $250. So probably total between that and the cash flow, we're getting about $500 a month for nothing on me, and only $15,000 from them. All right, so here is a chart that shows my equity partnership model. And I say mine, I was actually taught this and just, maybe modified it a little bit, but this is what my training taught me, and I've implemented it very successfully and been able to raise, over $1 million with this equity partnership model, well over $1 million with this equity partnership model to do my flips. This is how most of my flips are set up. So here's how it works. I set up a limited liability company, an LLC, and then I find equity partners. So once I'm trained and know what I'm doing, I provide, if you look over here, I provide 100%, and it says onlineowners.com, that's my S Corp. That's the name of my S Corp. So that's me, all right? So I provide 100% of the expertise, the education, the experience, and the time. In other words, I do everything. They provide 100% of the financing. They provide 100% of the funding, the money, okay? And then we split the profits 50-50. This is a model I've been using for years, all right? They get 50% of the profit, I get 50% of the profits. And keep that 50% in mind, because when I talk about how I analyze deals, this will come into play, that they get 50% of the profit and I get 50% of the profit, okay? Now, this is the challenge with this model, is again, doing the first one, right? Because they're gonna come to you and they're gonna say, wait a minute, we're putting in all the money, we're trusting you that you know what you're doing so that we're gonna make money on it, right? I explained to them, yes, that's exactly right. I wanna emphasize in this model though, before I guess I go there with the experience, keep this in mind. With this model, if I do a real estate deal and I don't make them money, how much money do I get paid? Zero. I could find the property, I could get the contractors, I could spend hours and hours and hours of my time over a 3-month period, 6-month period, whatever, to do a deal. And if I don't make them money, I don't get paid. I tell people to think about that as a business. How many other businesses could you get involved in and you could tell the employees, I want you to work hard for me every single day, but I'm not going to pay you unless I make a profit. It's just not going to happen, right? I say, a lot of times I'm meeting with people in Panera Bread back when we could meet in restaurants. And I would say, that would be like owning this Panera Bread franchise. In the first day, when you're meeting with your employees, you say, listen, I got this great compensation plan. Here it is. You're going to work hard for me every single day, but I won't pay you unless I make a profit. So I always explain that to these potential equity partners, that I really have an interest in making you money. It does me no good to do a deal, to have your money tied up in a deal if I'm not making you money, because if I don't get paid, okay? Now, that being said, they still like to see a track record and they want to see experience. So here, I'm going to give you 2 ideas, and this could go with a private money lender as well. One of the instructors that I had years ago did this. So the instructors, when they first got started in real estate, had no experience. What they did was they started to go to sheriff sales, which I'll mention, that's one of the find, the property. When we go to the F's under find, we'll talk about finding the property and we'll talk about sheriff sales. So these are where the bank is foreclosing, the lender's foreclosing, and it goes up to auction, and the lender will usually start the bidding at the amount that's owed, and then anybody over that are bidding against other third parties at the auction, and they get the property. Well, here's what they did, is they started tracking, and they would started going to these auctions, and they would write everything down, the property, what it sold for. And then they would track that property months later when it came on the market, and they would then see what that property sold for. And they'd also look at pictures. Obviously, if someone's got it on the MLS, they're going to have pictures, or even a third party for sale by owner, they're going to have pictures. So they try to determine, based on what they knew about the property in advance before, which they're not going to get a lot of information. They might drive by, they might look in windows sometimes, but they try to determine about how much they spent on the rehab. So they would gather this data, and they had hundreds and hundreds of transactions. They had it on this long, back in the long computer sheet. They had this huge long spreadsheet, and they would meet with potential partners, potential equity partners, and they would say this: we have researched this, and we've been tracking real estate in this market for 6 months to a year. These are the profits that have been made on these real estate deals at the sheriff sales in the last 6 months to a year. Instead of these people making the money, we want to make this money with you. We are prepared to do it. We've got contractors ready. We know what these houses are going for when they buy them at the sheriff's sale. We know what they're selling for. We know what to look for. And finally, someone took a chance on them. Well, they went from doing one deal at a time to two, and eventually they had 13, that maybe more, but last I talked to them, they had 13 LLCs set up with $300,000 in each one of them. So they had raised $3.9 million with this one model, and they started from scratch and getting that first person to say, all right, based on you doing your homework and me wanting to do business with you, and maybe they had personal references, whatever, but they had gone through foreclosure, they'd gone through a lot of stuff. So financially, they were not in good shape, but they got somebody, and they probably gave away a little bit too much because they had to take, the first person that said yes was also going to be the contractor on the deal. And they said, you know what, we probably didn't make as much of it because that contractor kind of maybe double dipped a little bit, maybe overcharged a little bit in the LLC, but they were okay. Just like me paying 24% interest to my first private money lender. They were okay with that because it got them the first deal, got them credibility, and now they could get more and more private money or equity partners. So before I ask a few questions, let me just explain. So this, on this side, so the equity partners, in some cases, I've done this, and that's been one person. So one person might come, and this happened. One person came to my property tour. They saw what I was doing, the rehab. They saw the model. They saw this slide, and afterwards they talked to me, and they decided to, first they were in for 200,000. Then I think it actually moved up to 230. But after seeing this, they committed to 200,000. One person, 200,000. They wanted to start doing flips with me. Okay. So that's easy. One person's in on one side, I'm on the other side. We set up the LLC. We have two people. So let's say you determine you're going to do flips, and we'll just make the math easy, 200,000. So you could have one person at 200,000, right? Well, if you had two people, you could have two people in at 100,000 each, right? That might be a little bit easier. What about four people? So four people would be 50, 50, 50, 50. That would get you your 200,000. What about, do you think you could do 10? Let's see. What about 10 people? 10 people at 20,000 each. Would that work? So it could probably violates security laws. 8 to 10 is probably a little of a gray area. It would be challenged in court and it could be probably decided right away. But I stay away from that. The most I think I've ever had is, I think the most I've ever had is 7. I would not go north of that. I would not recommend it. And here's the logic. You say, well, wait a minute. And it's not even written in the law a certain amount. But here's the litmus test here. Is if it goes, let's say I have a unhappy partner. We didn't make as much money as they thought we should, or maybe even we lost money. They're unhappy. They're going and they're going to challenge this. And what they're going to say is, this is not a partnership. This is an investment. I had no say in what was going on. I had no say in what house we're going to buy. Or they're going to say, I have very little say. I'm one of 10 people. I've got such a minimal amount of say in this. This is not really a partnership. This is an investment. And if a judge decides that I created an investment, I created a securities without a securities license and without it being registered as a securities, I could be doing 20 years in jail. Okay. So that's why you got to know. That's why I say, if you invest in real estate, you're going to pay for your education and training, whether you know it or not. Not knowing that one little thing could ruin your business and maybe your life. Okay. So try to keep that number very small. That's one thing that I do, is just share the number. But I also do other things to ensure that I will never have this problem. And that is in the LLC agreement. And that's what binds us together. The LLC operating agreement. It states that we have to have 100% agreement to buy a property or to sell a property. All right. Those are the major decisions, or to take on debt. All right. So no one could ever make the case that this is an investment and Randy just took my money and he's doing whatever he wants with it. No, because every time we go to buy a property, now the way I do it is I'll make offers, counter offers, and then when it gets time to lock in the deal, or during, even if they accepted the offer, I've got my 5-day right of rescission review period that I put in there. So the review period, I then have all my partners vote. Hey, we got this deal under contract. Here's my evaluation of the deal. I'll show you my evaluation spreadsheet. Here's the evaluation of the deal. I highly recommend that we do this deal. Yes or no? Please vote. Within 12 hours, I need your response, because we need to move either forward on this deal or we need to decline the deal. So that's how I protect myself with this model. Okay. Question. So here's what I want to explain to people, and you could change this. This could be whatever you want. Here's what I do, is I make it very clear that we're not partnering on a flip. Okay. We are partnering on a business that does flips. Okay. Or we could do rental properties, or we could do 2 flips at a time, or we could do 3 flips at a time, or we might do short-term rentals, or we might do subject to acquisitions, or we might, right? Anything's possible. It's a real estate investment LLC. It's a real estate, company, an LLC. And right now we're focused on flipping. If we want to do something else, we can, but it's ongoing. So we do a flip, all the profit comes back to the LLC. I always take my profit out. And if there are multiple partners, if they all agree, they can take all of their profit out and we do the next one. Some of my LLCs, they just keep building, right? They make profit, they build, they profit, they build, they build, they build, they build. Others want the cash out after every flip. Now, some people will do an LLC, and this is entirely up to you, get legal advice. So the advantage of actually dissolving that is that you don't have anything lingering. Like a year from now, you don't have maybe somebody you flipped the house to 2 years ago now coming back to sue the LLC, and it's moved on to other deals and maybe even other partners involved at that point. So, I mean, the good thing about shutting it down is it gives closure to that. Doesn't mean that they can't take some legal action still against you, but it's not an open live LLC. I don't do that. It's an ongoing business. If my partners wanted to leave, that's when I would shut it down and close it off, or I would just take it over myself and keep it alive. I have about 20 LLCs, I think. So some of them where I maybe want to buy a partner out, or maybe they want to do other type of deals, or maybe now they've partnered with me enough, they've learned enough, maybe they just use this as a stepping stone to do their own deals. If they're doing their own deals, a lot of times I'll just take it over, myself and have the old LLC. But it could be done either way. It could be done a deal and then break it down. Though the disadvantage is starting them up, the expense of doing that, the time doing that. I have checkbooks for every one of my LLCs, debit cards for every one of my LLCs. So if I was to do that and shut them down after every deal, I mean, it's bad enough now having 20 LLCs to keep track of. I can't even imagine having 20, and then next year I got 20 new ones, and then 20 new ones the next year. I try to get their commitment. I don't have them put this in writing because I know financial hardship sometimes comes out of nowhere. But I tell them this is I don't want you to come into an LLC unless you at least can commit to 1 or 2 years, right? At least going in. If things are going well and you're making money, I really don't expect anybody to leave to 1 or 2 years. Now, after a year, or about a year, I have had people come to me and say, listen, I lost my job or whatever, I need the money or whatever reason. I said, listen, I'll try to find, you try to find, and I'll try to find someone to buy you out. So that's how they leave the LLC. We do a buyout. And I have people, that I meet all the time, and they say, hey, Randy, I've got $50,000, $100,000. Do you have any opportunities to partner together? And just the other day, somebody asked me that. And $50,000 out of $55,000 is what it would take to buy out one of my partners. One of the partners had been in a while. They wanted to be bought out. $55,000 in, exchange, and I switched it out. I don't like to do it because now you got to change the LLC agreement. And when it comes time to sell that property, and a lot of times the lender, the attorneys the title company might want to see my LLC agreement. Now it's a little messy. This partner was in, now we got this buyout agreement. Now it looks like that. So I really try to minimize that. But at this point, it's happened once in a while. Maybe, I think I've had maybe 3 buyouts so far, maybe. Yeah, maybe 4. I just thought of another one. Yeah, probably 4. But yeah, good question. Okay. All right. And I think if I ever had because now I have a property that I may develop into a long-term buy and hold where we're developing either a mixed use strip mall and apartments above, or maybe all apartments. So this is definitely a long-term deal. And most of the LLC partners got into that with the intent of doing flips. So my intention, if I'm going to do that long-term deal, is I've got two LLCs that are involved in that. I actually will start a third LLC, and they'll sell it to the third LLC, and whatever partners want to continue in that long-term strategy will stay in that new LLC, and I'll probably dissolve the other 2 LLCs. So most of the people I deal with do not have $200,000 sitting in a checking account or a savings account, but what they do have is retirement accounts. Most of my funding, I'll just take a guess, probably 75% of my funding, if not more, come from self-directed retirement accounts. So you need to learn all about self-directed retirement accounts. If you don't have the money yourself, you need to be an expert on self-directed retirement accounts and on setting up LLCs. So self-directed retirement accounts, our instructor's phenomenal. He literally wrote the book on self-directed retirement accounts. It's called the Self-Directed Retirement Handbook. And his name is Matt Sorsen. He's an attorney. He's phenomenal. We get him to come to our office about once a year. And you really need to know the rules and regulations about self-directed. It's too much to go into today because I want to make sure I get everything on fix and flip. But make a note to yourself, if you want to have almost unlimited supply of capital, learn self-directed retirement accounts. It's estimated, and now it might have changed a little bit with the market, but last I heard the statistics, that there's about 23 trillion, that's with a T, trillion dollars in retirement accounts in the US, 23 trillion. Of that, it's estimated that about 7 trillion is eligible to self-direct. $7 trillion are eligible to self-direct. You've got to believe that some of those people, even if they're doing well in the stock market right now, you've got to believe some of them would like to diversify. And when they go to their financial planner, usually their diversification is, oh, well, here, you can diversify. Let's change this from this stock to this mutual fund. Now we're diversified, or from this stock to this stock. They're only selling things that they have to offer. So as a real estate investor that understands self-directed retirement accounts, you can help people move some of their funds, their retirement funds, to self-direction. And in return, you'll be able to have access to private money. I have private money lenders that use their self-directed retirement accounts, and I have equity partners that use their self-directed retirement accounts. And those are probably the perfect partners to use because they can't spend that money now anyway. So a lot of times they want to leave it in there. They want it to build up. They don't want to take it out after every transaction. They don't want to leave after a year. They want it for the long term. So that's where most of the funds come from, is not from someone's liquid assets that's in a checking or savings account. It is in self-directed retirement accounts. And self-directed retirement accounts, you have prohibited transactions and you have prohibited parties, okay? Prohibited parties are the parties that you can't transact with, okay? And you've got to learn those. You've got to know those, all right? How about your mother? Can you use your mother's self-directed IRA in order to do a real estate transaction? Yes or no?
Yes.
The answer is no. And if you did, you might forfeit her retirement account. Might have to be divested immediately with a penalty and in paying income tax. All right, so mother's a no. We can assume that a father's a no, right? There's no. It is no for the mother and father. How about your children?
No, prohibited.
Prohibited. All right. What about your grandchildren? Prohibited. How about your grandmother?
Prohibited.
Prohibited. What about your sister?
Prohibited.
Not prohibited. Brother, not prohibited. All right. How about your wife's parents or husband's parents, your in-laws? Actually, they're not prohibited. So you can see there's a lot of rules and regulations that you have to know. And yourself, you say, you're a prohibited party. You say, well, I would assume that there must be no way that I can use my funds and my retirement funds to partner together. That's not true. You can. There is a way to do it. When you set up your LLC, as long as your funds, your cash, and your retirement money goes into the LLC and starts exactly at the same time, let's say at the onset of the LLC, you can do that. But if your LLC is already established and let's say your retirement account is in your LLC and now you want to add cash, you cannot do that because that becomes a transaction and that's a prohibited transaction. When it's part of the LLC at the beginning, it's not a transaction. You're putting the company together. That's not a transaction, okay? So you should know all those rules, regulations. It's very important, but it can allow you to raise hundreds of thousands of dollars, if not millions of dollars, that I've been able to raise through self-directed retirement accounts. All right. And the other thing is prohibited transactions. You have prohibited parties, but transactions, just in a nutshell, are things like, it's very limited. You can't buy life insurance policy, you can't buy collectibles, and you can't invest in an S Corp. And that's about it. That's about it. So think about it. People don't know this, and their financial advisors are never going to tell them. You could buy Super Bowl tickets right now with your retirement account. And then when the teams are announced and it gets a couple weeks before the game, the big game, sell them for double, triple the price, and all the funds come back to your retirement account. And that's a legal transaction. It's not an insurance policy. It's not an S Corp. It's not a collectible. Okay, so we're going to leave this. And that concludes with us as far as talking about funding. And remember that expression, dig your well before you're thirsty. All right. So try to do that funding in advance